Hey everybody, this is Brant from Wolf on Wall Street Trade. It is a gorgeous day down here in South Florida. I should be at the beach, but I decided to jump on YouTube and give you a little video update. So, been a really strong month for especially the Dow. You can see the Dow here. This is a daily chart of it, up over 14% month on date. And what we were looking for at the website for subscribers was kind of like this W bottom you see coming into this. In a couple of the other averages like the S&P 500 and NASDAQ, it's more of like an inverse head and shoulders bottom. But we'll get a little bit more into that in a minute. So very strong rally here. But what does that mean? Does that mean we've hit a bottom? We're at the market low? Not at all. So if we look at the primary trend, let me pull up the S&P 500 and back out a little bit. You can see what was a top forming in 2021, and we're actually calling for this to happen. I'll show you on 3C. Something like this. It's not exact, but actual point I'm trying to get to is what is the primary trend. So a lot of financial media will define a bear market as down 20%. That just depends on a stock or a market's beta. So if Tesla is down 20%, that could be just a pullback in Tesla. I define a bear market as a primary downtrend, and we can see that here as the S&P 500 is making a series of lower highs and lower lows, okay? Sorry, it's a little bit sloppy there. So this rally is nothing but a bear market rally, so we have to acknowledge that. But at the same time, there have been some interesting changes in character or tone with the market. So we're going to jump to some intraday charts, and this is a 30-minute chart of the S&P 500. You can see that inverse head and shoulders right in here, and then the price action coming off that low, the October low over here, is just very bullish. You know, you have a bull flag here. Let me zoom in a little bit more. You have a bull flag here, something like a pennant or like a little descending wedge, and price breaking out of that. Like I said, the Dow already smoked our upside target, and here's that intraday chart that is showing the kind of W base right in here, and there's the target. So it already smoked it. Again, bullish price action here in the Dow as well. And quite frankly, looking at the SPY over here in 3C, this is one of the main reasons that I was looking for some kind of a bottom, well, not a bottom, let's say a base of some sort. Tried to do it right here in front of the last Fed meeting, like a little W base, and then the Fed came in much more hawkish than the market expected. Came down here is our inverse head and shoulders again. You can see SPY, this 5-minute chart, is positive coming into that. It's positive divergence. And if we take a look at some of the more recent price action, I'll go down to like a 1-2 minute chart and change the symbol to the diamonds, which is the ETF for the Dow. You can see coming into that second bottom over here, again, 3C positively diverging into that, and it's been confirming really well this entire rally. Now, like I said, the Dow already smoked our upside measured move target. NASDAQ is not even close. NASDAQ hasn't even broken out yet. S&P has got 2 upside targets that are still a bit north of here, and small caps as well. But I do think as we come into this week with the Federal Reserve meeting, the FOMC meeting on Wednesday, or at least the policy announcement, I do think we're going to see some consolidation, and we're already seeing signs of that in the Dow, which has been really the strongest 3C chart on the short-term confirmation. Here it is on a 1-minute chart. You see excellent confirmation, positive divergences in here. But over here, we're starting to get a negative divergence. And this is kind of along the lines of what you'd expect to see before a pullback or some kind of consolidation. And usually when measured moves are hit, the next thing that happens is either a consolidation or a reversal. So the question is, what makes this rally any different? Because it is a little bit different, and start seeing signs of that in August. It has much better breadth than any of the rallies we've seen prior to this year in the bear market, like bear market rallies. Here's a quick 30-minute chart of the S&P 500 and the percentage of NYSE stocks that are trading above their 200-day moving average. You can see into the market top last year, it's falling. That should be rising. It shouldn't be falling. But you can also see coming into this bottom over here in October, you can see positive divergence in a lot of these breadth indicators. So there is a little bit of a change in character, and we can see that even more so when we look at small caps. Small caps have a tendency to lead kind of risk sentiment, I would say. So they have a tendency to kind of lead the broader market. And if you look at what they did in 2021, I mean, it was just kind of a toppy pattern except for 2 weeks over here where it tried to break out. Failed breakout, fast reversal, that's really common. But what I want to kind of highlight here is a call that I made in August right over here was that I said, I don't think we're going to exit the bear market, but I do think that we're going to head into more of a lateral price trend. We can see that with the IWM here with small caps. Not a lower low, held up over here at the June low. I mean, it did dip just below intraday, but that's nothing unusual. In any case, that is a serious change in character. Suggests to me, I think, that we could be in for a little bit more of a lateral move, kind of like to the right over here. I do not think at all that this is a market bottom by any means. But I don't want to dismiss some of the really interesting changes in character we're seeing. I'm going to show you some long-term 3C charts, what they were saying last year as the market was rallying and what they look like now. So that's a 60-minute chart of the SPY, and this is 3C over here, confirming the primary uptrend until we get into this top area that I was talking about last year where market breadth was falling apart. All that, you can see 3C negatively diverging on this longer term time frame. So that was one of the reasons to when the market was making all-time new highs, you know, many times last year, that it was like, watch out, this is not what it appears to be. There is a lot of weakness under the surface. This is probably the worst market breadth I've seen in the last 20, 25 years of doing this, coming into this high. But what we're looking at right now is the S&P did make a lower low, just like the SPY over here, a primary trend lower low. And 3C hasn't done anything different. It's making lower lows and lower highs as well. So it's saying that we're still in this bear market. However, there are some areas of interest. Take the Dow, for example, which I pulled up here. Again, 3C long term was confirming this rally until we got into like the highs of last year, negatively diverging. But here's where it gets interesting. Look what's going on over here. Now, the Dow just had a really strong month, really strong performance, and 3C is reflecting that over here. This is a change in character, but it is not really breaking that primary downtrend. You can see 3C still making lower highs. The primary thing to understand is what is driving the market. Bear market rallies are strong. They're some of the strongest rallies you'll ever see. And they have a job, and that's to fool people, suck people back in to think that the bottom is here and the Fed's about ready to pivot and all that stuff and front run. There's always a narrative to these bear market rallies. And two of the main drivers that have an inverse correlation with the market right now are the US dollar and treasury yields. So every time treasury yields go up, what happens is the mega caps dump. They got way overvalued last year, and when rates rise, their forward-looking valuations have to be discounted. So the thing is, a rally can't go anywhere without the mega caps, and they haven't been acting great, but we did get a couple things that were necessary for this October rally. Now, the first was that the dollar stops rising. So you can see this is the COVID crash, a flight to safety. This is a reflection of the Fed cutting rates, buying assets, doing all that stuff they did. And this is a reflection of the Fed finally getting it that inflation is not transitory but was embedded, which, by the way, the copper gold ratio here in red told us about March of last year that the 10-year yield, which is in blue, it was around 1.54%, should be trading about twice as high as it was, should be much higher. So the market was already seeing the inflation that the Fed was still calling transient. So if you watch what happens to this blue line, it catches way up, it doubles in rates, and here we go. Boom, there we go. So well past, we have it above 4% right now, 4.01%. But to get back to my point, the two things we needed were, one, the dollar to stop rallying. And if we look at the dollar here, let me zoom in a little bit closer. Actually, I'll just go to a different time frame. Let's put it on like a 4-hour. So we needed the dollar to stop rallying. And we got a CPI print over here that was really hot, and the dollar didn't make a new high. So the idea was, hey, I think we have an open window for the market to rally as we came into October, because the dollar was at least starting to consolidate more sideways, okay, rather than going up, because there's a very, very strong inverse correlation between stocks and the dollar. The second thing we needed were for rates to do the same, for yields to do the same. And this is the 10-year yield that we're looking at on an hourly chart. You can see this huge uptrend since pretty much the start of August. One little break here, that was the intervention of the Bank of England to basically bail out the pension funds. And this is what we needed. So we saw some things happening here. There was an article released by the Fed Whisperer from the Wall Street Journal, and that was what actually broke yields down. So if I just move forward in time, you'll see that yields broke this trend line. That allowed the market to really rally. If we take a closer look at the price action in yields, or the yield action in yields, it still looks bearish. It still looks like we could see another leg down. Now this, of course, is all about the Fed pivoting from, not from rate hikes to rate cuts, but from being less hawkish than the market had already priced in. This is where that Wall Street Journal story came out, and the yields just broke down. So we do have the Fed meeting on Wednesday, the FOMC meeting. At 2 o'clock, we have the policy announcement, and at 2:30, we have Powell. So there's no SEP, summary of economic projections, in this one at all, so you won't get the dot plot. So Powell has a lot of room to craft the narrative around whether the Fed is getting less hawkish. That's not to say that they're going to cut rates. Again, less hawkish, which might mean in December, instead of 75 basis points, they go 50. That would be less hawkish. In my estimation, this has nothing at all to do with inflation. There's really no sign outside of commodities that inflation is really slowing or coming under control. What I think this is about is stress in the financial system. Last year, I was telling my members, if the Fed has to choose between supporting the economy or fighting inflation, they are going to fight inflation, and they will, and they want the economy to go into recession. So they're much more worried about inflation than a recession. They actually need the recession. They need the unemployment rate to go higher to pull down demand to help bring down inflation. That is not why I think, if they do have a little bit more dovish pivot, that they are. The reason, I think, is the strong dollar has been breaking everything. And the only thing worse than inflation or stagflation is a breakdown in the financial system's plumbing. Okay, hopefully you can see this, the website, macro to micro. And this is the FRAOIS spread. If we kind of zoom in on this a little bit closer, this is kind of like a reflection or a barometer of stress in the financial system. And what you can see is in September, this thing really just started skyrocketing. And this is around the same time that you're seeing the Bank of Japan have to step in and try to intervene on the yen's behalf. The UK had to bail out pension funds because rates were exploding. And there was the Swiss National Bank that needed a lot of dollars from the Fed. I think that may have something to do with Credit Suisse. I don't know. But the point is, we're not at severe stress levels. You know, this is like the COVID shutdown over here. This is the financial crisis. But there is a big move over here the last month or so. So I think if the Fed does get a little bit more dovish or hint at a slower pace of rate hikes or smaller basis point rate hikes, it is probably because they are seeing stress in the financial system. And that's the only thing they fear more than a recession or an inflationary recession, is a breakdown in the financial system. And that's what was happening over here during the financial crisis. You can see this spread just blew out. So elevated, not in like red alert zones, but elevated. So that would be my guess. What you want to do on Wednesday, when the FOMC policy announcement comes out, stocks will almost always knee-jerk, and that initial knee-jerk is almost always the wrong reaction. You want to watch the dollar. So here's the dollar here. I'm not exactly sure if this is going to be kind of a bull flag consolidation or if it's a kind of a bearish descending triangle. It's just in consolidation right now, and it's kind of waiting on the Fed. So if the Fed is more hawkish than the market's priced in, then the dollar should go up. If the Fed is more dovish, or if Powell in his press conference is more dovish, and you have to wait for the press conference because he is going to shape the narrative, then the dollar would come down, and that would be good for stocks. You can watch yields too, especially the 2-year yield, which is a reflection of Fed funds rate. This is just the 10-year, but again, to me, it does look bearish right here, but it's kind of in consolidation going into this uncertainty of the FOMC. So I do see a lot of interesting things happening on the charts that are stronger than we've seen with prior bear market rallies this year. My instinct, my gut is that we do have a little bit more upside. There's a couple measured moves that haven't been met yet, but we could kind of go into consolidation coming into the Fed. And then it really just depends on what Powell says from there. But there are some interesting characteristics to this rally that I haven't seen in others. And what I mean by others is other bear market rallies this year. Again, one of the primary ones that sticks out to me, because there are a lot, and if you're a subscriber to Wolf on Wall Street, you know what I'm talking about. There are a lot, but one of the primary ones that sticks out to me is this long-term DIA 3C chart, kind of leading to the upside. I follow about 30 different metrics of market breadth. This is the percentage of NYSE stocks that are one standard deviation above their 200-day. And, you know, it all makes sense. You watch this, it all makes sense. But over here, this higher low, that is where we're seeing some really strong breadth. And as we come down into this kind of little basing pattern that I talked about, for the Dow is like a little W, for the S&P, a little inverse head and shoulders. Look at where this is compared to where it was in August, at the August market highs. Much stronger breadth. It's just a different rally than we've seen this year. And for my members or subscribers, you know that since like mid-August, I've been looking for more of a lateral trending market, and we can see that really well in small caps. They held that June low, and they're starting to move a little bit more sideways. So I do think there's more room on the upside. Obviously, the Fed is going to be the pivotal event of the week. But if I lean towards anything, it would not be a market low, like this is an actual bull market bottom. Not at all. I would lean to a more lateral trending market, a more sideways trending market. Maybe the intermediate term trend goes into like a lateral phase, which we can already see starting to happen in small caps. That would be great, I think, for swing traders. And I'm not trying to make a bullish case here. I'm just saying I think we do have the opportunity for some more upside. When we see the indicators start breaking down and getting ugly, I would jump back on this thing short, because I do think the bear market is still well intact, and we haven't gotten the kind of signals that you would see near a bear market low. Not even close. So for my subscribers, you know what the two targets are for the S&P 500. So we do have a little bit more potential upside there. And we'll just continue watching how this develops. But watch the dollar, how it reacts. It's basically a barometer of whether the Fed is hawkish or dovish compared to the market's expectations, or what the market's already priced in. So if the dollar moves higher, that is going to be a hawkish take. If the dollar moves lower, that is a dovish take. Dollar moves lower, that helps stocks. And I'll show you what I mean real quick. S&P futures, this is a 4-hour chart. What I'm going to do is just put the dollar on this chart, but I'm going to invert the price, because as I said, there's an inverted or negative correlation with the dollar. So this is the US dollar index in blue with the price inverted. So the way you do that on TOS is a minus sign in front of the ticker. And you can scroll back and just look at this. It's not a perfect correlation, but this is the dollar moving higher, and this is S&P futures moving lower. So there is a very strong correlation there, and also with rates. And you can just use Treasury futures, because rates move opposite Treasury future prices. So what I'm going to do is just change this to the 10-year Treasury. And again, it's not a perfect correlation, but if we kind of go back, you can see Treasury's moving down, the blue line. That means yields are moving up, and S&P futures are following it. Generally speaking, it's the mega caps that get hit when yields rise and kind of limit rallies. So for this rally to have any legs, the mega caps really have to participate, and we didn't really see that until Friday with Apple. So to put a neat little bow on this, still in a primary bear market that is based on the primary price trend. Okay, there are some little areas of interest. Like I said, small caps. They've put in an equal low here, almost like a big W bottom. I would not say bottom. Let's just say base. Okay, and that's the same thing we got here. My point is, I do think there is a potential of the market turning more lateral and sideways, and people are usually either bearish or bullish, but there are three market trends. Price goes up, down, or sideways. And my leaning is a little bit more towards sideways, but still in that primary bear market. And I do think we are going to make new lows in the primary bear market. All right, hope you enjoyed this video. It's been a while. So if you liked it, please give it a thumbs up. Subscribe, hit the little alarm bell that will let you know when new videos come out. Have a great rest of your weekend.